Welcome to our video. We officially now start getting into forex for what it is. So in this video we're going to go through what a pip is, what leverage is, what a broker is, and we just now start getting into details with now forex in general. So most of the things that I'm going to say in this video, especially at the beginning, is mostly for knowledge sake, for you to know what how this forex thing is actually working. And like just diving into the charts directly and you start trading, you need to actually know what you're doing. So the pictures were gotten from www.wysetrade.com. so it's a good site. You can actually go there for more information. So just a recap from the previous video on what forex is. Forex is a market that is largely traded. About 5.4 to 6 trillion is traded every day in the market. It's one of the largest markets in the world. So just to show you abbreviations of currencies, because as we said in the last video, forex is short for foreign exchange, so buying and selling currencies. So the abbreviations are going to be seeing in currency pairs is, the first one is USD, and this stands for the United States dollar. The second one is AUD, which stands for the Australian dollar, but it's also called the Aussie. So if you hear people saying the Aussie in forex, are talking about the Australian dollar. And then the next one is the New Zealand dollar, abbreviated as NZD, also called the Kiwi. So if you hear the Kiwi, they're talking about the New Zealand dollar. The other one is the Euro, abbreviated as the EUR. So if you say EUR, we're talking of the Euro. The other one is the Canadian dollar, which is abbreviated as CAD, and it's called the CAD in forex. The other one is the GBP, which is the pound. It's also called the pound in forex. And then we also have the Japanese yen, which is just called the yen. But there's also the Chinese yen, but if you hear the yen, in forex, they're most likely talking about the Japanese yen. And then there's also the Swiss franc, which is abbreviated as CHF, and it is called the Swiss in short. So now, what is a currency pair? Because as you know, we are trading pairs. As we said in the last video, you can't trade one thing. A trade is an exchange between two things. So you're supposed to trade something that has two. You're supposed to be buying one and selling the other, or selling one and buying the other. So a pair is a combination of these that I'm talking about. So this is an example of a pair, which is the GBP versus the USD. So this is GBP USD, and as I said in the last video, the first currency in the pair is called the base currency. The second one is called the quote currency. So if they say GBP USD is equals to 1.2655, I'll repeat that again. If they say the GBP USD is equals to 1.2655, what they are saying is 1 Great British Pound is equals to 1.2655 USD. So as we said in the last video, the base currency is always 1, and the quote currency is always the number that is given that side. So if you buy the GBP USD, which in forex we call it going long. So if you hear someone saying I've gone long on GBP USD, they're simply saying they bought it, right? So if you buy or go long on GBP USD, what you are doing, as we said in the last video, happens to the base currency. So if you buy GBP USD, you are buying the GBP and you are selling the USD. And then if you short, which is selling, so if you hear short in forex, it's selling. So buy is going long, selling is shorting. So if you short or you sell GBP USD, as we said, what you do happens to the best currency. So you're going short on the GBP, or you're selling the GBP and you're buying the USD. So meaning, if you hear, example, just as an example, here economic news that says the United States dollar is going to gain strength, so you want to buy the USD. So on this, you have to sell the Great British Pound USD, because you've heard the USD is getting stronger, so you have to sell this pair. But if you think the USD is going to get weaker, you need to buy the GBP USD. We'll talk about this more when we go into analyzing and knowing how to buy and how to sell. But all you have to know right now is, if you buy, you're buying the base, you're selling the quote. If you sell, you're selling the base, you are buying the quote. And then these are major currency pairs in forex. So there's 7 major currency pairs, and the rest are minor pairs. So if you notice, all the major pairs have the USD in them. This is because in the time when people used to use gold, a long time before money was invented, they realized gold was hard to carry around. Imagine you want to move from one province to another province, or from city to city, and you want to go buy something big. Gold is heavy, so transporting that gold is going to be a challenge. So what they did is, they came up with banks. And what they are doing is, you go to a bank, you give them gold, and if you give them gold, they'll give you paper money. That's how paper money came about. So one note represented gold in a bank, right? But in World War II, countries started printing out more money than the gold they had in their central banks, because of the war. They wanted to create more weapons, and they like to win the war. So now the banks realized, saying there was a lot of money printed than the gold that was in the banks. So banks started refusing to get the money in exchange for gold. And at that time, the United States had half of the world's gold, close to half of the world's gold. So what they did is, they said the United States dollar is still going to be backed up by gold, but all other currencies will be backed up by the United States dollar. That's why, even though you see the euro or the Great British Pound gains more value than the USD, you still notice that the USD is still going to be um, the world's largest economy, because all other currencies are backed up by the United States dollar. And if you notice, in all the major currency pairs, the USD is there. So there's Euro USD, there's USD Japanese yen, there's Great British Pound USD, USD Swiss franc USD, Canadian dollar, Australian dollar USD, New Zealand USD. And these are the ones we're going to focus on trading, because they're the most liquid. They're the ones with the most liquidity, they're the most traded in the marketplace. So it's easy to go in and come out of positions. So we'll focus on these in these lessons that we're going to have. So our next topic is, what is a pip? Yeah. So a pip, in short, is short for percentage in point, or price interest point, right? So you don't really have to know this. A lot of people who make money from the forex, they don't even know what a pip means, but I just brought it out for knowing what it actually stands for. But in short, a pip is just a measurement of one market movement, or what we assume a market movement is. So I'll give an example. Let's say Euro USD is equals to the number you see on the screen. That's 0.6751. A pip is the fourth decimal place point. The fourth number after the decimal point. So if you look at the 1 there, that is the pip. So if Euro USD moves from 0.675 to 0.6752, the 1 has changed into a 2. We'll say it has gained by 1 pip. Yeah, right? So these pips are always moving, and we're going to see how we can really make money from these pips. So as we've mentioned, a pip is the fourth point, the first number after the decimal point. So apart from the USD JPY, so currencies that have JPY, them, they don't go up to the fourth decimal point. A pip for them is the second decimal point. So example, if you USD JPY moves from 146.22 to 146.23, we say it has moved by a pip. So apart from JPY pairs, every other pair, it's the fourth decimal place. So now let's go to our next terminology. All these terminologies I'm talking about right now, they don't make sense, but at the end I will sum them up together. The pip, the leverage, the lot size, will sum them up, and we're going to now actually paint a picture of what forex really is. So just stay up to the end, take down notes of the meaning of these things and how they are. At the end, it will make a lot of sense, trust me. So what is a lot size? A lot size is the amount of position you are buying of the base currency. So let's say you open a lot size of 1. So one lot size, right? If you open one lot size on Euro USD, what you are saying is you are buying 100,000 euros, right? So that's a standard. So one lot size is equals to 100,000 euros, right? So if you're trading, this is a screenshot from a platform called MT5. We're going to get into it in the future videos. Before you buy and you sell, on the middle there are these numbers that are in red, which is 0.001. That's our lot size, right? If there our lot size, we put 1 and we click on buy. What we're saying is we have bought whatever pair that we are trading, the base currency of it, 100,000 of it, right? And now just to calculate this for a bit, let us say a price moved by 1 pip, right? And um, we said 1 pip is the fourth decimal point. So if price moved by 1 pip and we opened a lot size of 1, which is 100,000, you notice that one small movement, one small step can get us $10. Are you now trying to see how this makes sense? And like going to buy, you get your $100, you go to a bureau, you buy a Great British Pound, you buy the dollar. Those small pips that are moving every second, they won't be of any value. You won't see any value. But if you open an account with a broker and they're able to open a position of 100,000 using the broker's money, not your money, using the broker's money, for every step the price goes in your direction. So if you buy and it goes up by a step, you make a $10. If you sell, it goes down by a step, you make a $10. I guess you are trying to see, but you can't only open a standard lot. As you can see in this picture, there is 0.001. So that's not a standard lot. You can actually open a smaller position, right, than that. So if you open a mini lot, which we said the standard lot is 1, right, and that's 100,000. A mini lot is 10th of the standard lot, and it's 10,000. So if you open a position of 0.1, not 1, which is here, you open a position of 0.1, means you're opening with 10,000. So meaning every one movement of a pip will be equal to $1, because we're going to do the 10,000 times the 0.0001, which is going to be $1. And then we also have a micro lot, which is a 10th of a mini lot, which is 1,000 of the units of the base currency. And meaning 1 pip movement is going to be 10 cents and the like. So you get to choose how big of a position you want to enter based on the lot you place. Before you press buy and sell, there's a lot. So that lot number that you put determines on how big of a position you want to enter. And remember, if you put a standard lot and you're gaining $10 when you move your direction, also realize that you'll be losing $10 if it's going against your direction. So it's a double-edged sword. So yeah. So and then there's also something in forex that we call the bid and the ask price and also the spread, right? So in forex, these guys are called the brokers. They will give you a ask and a bid price. It's like when you go to a bureau. When you go to a bureau, they will tell you, example, $1 they are buying at, um just an example, 28.23, and they'll tell you they are selling at 28.95 as an example. So you notice that the price they are buying and the price they're selling, there is a small difference in between, right? So the price they are buying the asset, or the price, I mean the price they are selling the asset, is the price you are buying the asset, right? So they call that the ask. That's what they're asking for, right? So you, when you want to buy an asset, when you want to go into a buy, you have to pay the ask price. And then when you want to sell an asset, you have to pay the bid price. So now the difference between the bid and the ask, that's what we call the spread, and this is what the broker uses for to make their profit and also to run the costs for the trade. Obviously, these brokers, you don't think they're going to give you hundreds of thousands to open trades just like that without them having any benefit from this. So if for every position you enter, when you enter and you come out, you get a commission from it, and that commission is called the spread, right? So whether your trade lost, your trade won, they're getting a commission from every trade. And now, talking about brokers and what leverage is. Although I've already explained a bit of these, but let's go on. So what leverage is, as we said, when you're opening the lot size, the broker is the one giving you money to open the position. The money you deposit in forex is just collateral that the broker uses. The broker says, we'll give you as much money as you want to open a trade, but if the trade starts going in the opposite direction and you wrongly analyzed or you guessed or whatever, it's not going in the wrong direction, we as the broker don't want to lose the money we gave you. The money we're giving you is leverage to help you maximize your earnings, but we don't want you to lose our money. So give us money as collateral. If the price that's going opposite, let's say example, you opened a standard lot, as we said, which is 100,000, and every step is $10. So every step it goes against you, $10 is going to be lost. And the brokers don't want to lose money from that 100,000 they've given you. So they'll tell you deposit something. So you deposit, just as an example, $100. To deposit $100, when it starts going against you, the money that's going to be deducted is from the money that you deposit. And if that money that you deposit completely finishes, the broker closes the trade, gets back their money so that they don't lose anything. So the money you deposit in forex is more of collateral, and it is not the money you use to open a trade. That's why a person who trades forex using a broker on their phone can make more money than a person who goes to a bureau and buys actual dollars or the Australian dollar or whatever. Because if you go and buy with your own money, you're using little money. So those small movements that we talked about, that peep, that small movement, it's not going to be worth anything, right? Okay, yeah. As an example, very quickly, let's say you bought $100 and price moved by a pip, right? You notice that one pip is going to give you how much? 1 cent. It's now from 1 cent. How many pips do you actually need to make $1, which is going to take months of price moving? So that is why we actually open an account with a broker. I'm sure you guys have already opened an account with a broker by this time. I sent you a link. If you haven't yet opened, you can text me, I will resend the link, or you can just go to the link. I'm sure I've already sent the link. And if this is on a platform like YouTube, the link should be somewhere in the description or my bio somewhere. Feel free to text me for the link to the broker. So now, when you're opening an account with a broker, which I'm sure you guys have already done. There's something that they call leverage ratios, right? Which they offer. So you see things like 1 to 50, 1 to 100, 1 to 500, 1 to 1000. What this means is the amount you and the broker will go into that position together. So if they, let's say, the leverage is 1 to 1000, what they simply mean is, for a position that you want to enter, divide that position by 1000, and that's the money you need to put in. Then they'll put in the rest, right? So I'll give an example. If you want to open a standard lot, right? A standard lot, you want to open a position with 100,000. So let's go to a calculator. So you want to open a position of 100,000, which is a standard lot. If you have a lot size of 1 to 1,000, so we can say 1 divided by 1,000, and we can multiply that by a standard lot, which is 100,000, so which gives you 100. So it means for you to open a trade with a broker, that when you're signing up with a broker, you put the leverage of 1 to 1,000. It means you're supposed to have $100 in your account. If you have $100 in your account, you can open a standard lot size. If you have less than $100, you'll be required to open a smaller position. You can't open a lot size of 1. You have to open 0 point something, 0 point something, and yeah, that's how you calculate on how much you need to put for the position you want to open. So if someone has a leverage of 1 to 500, just as an example, right? For them to open an account of a standard lot, which is 100,000, that person actually needs $200. So you notice that the smaller leverage you get, the more money you need to open positions. The higher the leverage you get, the less money you need to open a position. Anyway, we'll talk about this more. Leverage can be your friend, it can also be your enemy if you don't know what you're doing. So yeah, we explained these traders will be required to deposit a margin, and the deposit acts as collateral for the leveraged position. We explained that. So now, how do we now make sense? How do people make sense out of this forex thing that we're just talking about? Like, how do we know where it's going to go? How do we know what to buy? How do we know what to sell, when to sell? Are we just guessing, or is there a bias for us actually knowing these things? So there are actually two ways you can tell where the market is going. The first one is called technical analysis, and technical analysis is just using past price actions, just studying the market, right? Saying, okay, the last time the market did this pattern, it went this direction. Because you notice something in the market, patterns always repeat, right? If you sit down, analyze data of the pair you're trading, you look at certain patterns that always repeat. So you just have to wait for these patterns, and when these patterns start reforming, you get to know, saying, this pattern is what I was waiting for. I know when it does this, it's about to go up, let me buy. If it does this, about to go down, let me sell. And we'll get into these like more details. This is just one example. If you saw the market is making a high that is higher than the previous one, and the low that is lower than the previous one, so it's going high, high, higher, low, higher, high, higher, low, higher, high, higher, low, higher, high, higher, low, you can predict that, okay, this market is in an uptrend and it will continue going up. So you can predict that it will also make another lower low, and then to make another higher low, and then continue making the higher highs and continue going higher and higher and higher. So we'll talk about this in the next videos where we dive into technical analysis properly. This was just an example. Another way you can analyze where the market is going is called fundamental analysis. While in technical analysis, you are looking at price action and what it's doing on the chart. Fundamental analysis is just looking at the country's economic indicators, right? Things like the GDP, things like inflation of the country, how are jobs in that country, are jobs being added, are jobs being removed. All these are indicators on how whether a economy is getting stronger or is getting weaker, right? Things like the interest rates and the monetary value of the country, things like political events and the government policy changes, the central bank statements, any news or any significant market events. All these things are things that can indicate whether you're supposed to be buying or selling the currency. Of course, we're going to go into details. There are actually uh, websites that I'm going to show you where it's going to be like this is an example where you can see saying, okay, we're about to have news release on the GDP of a country, or the interest rates of the country, the trading balance, the imports, the exports, and they'll tell you saying, okay, this event is happening at this day, this time. They'll also tell you the impact of the event. Is it going to be medium? Is it going to impact the market very high, or is it going to be low? And they'll actually tell you the actual release that has come out, and the forecast. Of course, for the actual and forecast, when we start doing technical analysis, they're going to actually make more sense because we're going to go into them a whole lot deeper. So yeah, for now I think that's the end of the video. You can always come back and rewatch this video, for this is the foundation of forex. We have laid a foundation even as we start now the actual trading, because the next time we are going to meet needs to be now on the charts. You need to start technical analysis. You need to see live examples of how the money and everything is now being made. So this is the foundation. If you've understood this, everywhere that we're going now, this was the bread and butter. And the most confusing part, I'm sure if this is the first time you've heard any of this, you're confused, feel free to watch the video again and again, and I will communicate with you when we're going to have our Google Meet sessions. If you have any questions, you can let me know in the Google Meet sessions, or you can text me after watching this video, or any of the traders that you know at FX Masters at any time. Will be glad to respond to you.